I honestly can't think of a question that I get asked more often than should I buy Nvidia stock? And it makes sense. The company's stock price has been on absolute fire the past year. It's down about 5% this week, which is a bit surprising since they announced some truly innovative things at 2025 CES. They have things like compact AI supercomputers under Project Digits. They announced their 50 series GPUs that are insanely powerful and make the last generation look way weaker. I mean, heck, Jensen was literally surrounded by robots when he announced that robotics were about to have their ChatGPT moment. This company is an incredible company. There's no doubt about it. And normally in these videos, we do deep financial analysis. We look at their growth strategy. We look at what past growth has been. We look at if the CEO is actually delivering on their big ambitious goal. But I'm going to play you two clips. First, one from Jensen Huang, and then another one from a legendary investor. See if you can pick up what I'm putting down. They're a little bit on the longer side of things, but I really think hammering in this point and understanding this is essential to becoming a great investor, which I, Warren Buffett, and this legendary investor all think you are capable of becoming, or already are.
Here it is. Our brand new GeForce RTX 50 series Blackwell architecture. The GPU is just a beast. 92 billion transistors, 4,000 TOPS, 4 petaflops of AI, 3 times higher than the last generation Ada. And we need all of it to generate those pixels that I showed you. 380 ray tracing teraflops, so that we could, for the pixels that we have to compute the most beautiful image you possibly can. And of course, 125 shader teraflops. There's actually a concurrent shader teraflops as well as an integer unit of equal performance. So 2 dual shaders, one is for floating point, one is for integer. G7 memory from Micron, 1.8 terabytes per second, twice the performance of our last generation. And we now have the ability to intermix AI workloads with computer graphics workloads.
Now, here's legendary investor Peter Lynch back in 1994.
They make a 1 megabit SRAM, CMOS, bipolar risk, floating point, data I/O array processor with an optimizing compiler, a 16 dual port memory, a double diffused metal oxide semiconductor monolithic logic chip with a plasma matrix vacuum fluorescent display. It has a 16-bit dual memory. It has a Unix operating system, 4 whetstone megaflop polysilicon emitter, a high bandwidth, that's very important, 6 gigahertz, double metallization communication protocol, an asynchronous backward compatibility, peripheral bus architecture, 4-wave interleave memory, a token ring interchange backplane, and it does it in 15 nanoseconds of capability. Now, if you own a piece of crap like that, you will never make money. Never. Somebody will come along with more whetstones or less whetstones or a bigger megaflop or a smaller megaflop. You won't have the foggiest idea what's happened. And people buy this junk all the time. I made money in Dunkin' Donuts. I can understand it. When there was recessions, I didn't have to worry about what was happening. I could go there and people were still there. I didn't have to worry about low-priced Korean imports. I mean, I just didn't have, I can understand it. And you laugh. I made 10 or 15 times my money in Dunkin' Donuts.
All right, I know that was a longer clip, but I think you understand what I'm trying to say. What Peter Lynch is referencing here is that you want to stick with companies that you are capable of understanding. Warren Buffett refers to this as your circle of competence. But before you say, wait, Dave, I want massive returns. Remember, I said Peter Lynch was a legendary investor. In the 13 years that he ran the Magellan Fund, he compounded at 29.2%, which completely crushed the market. If you would have invested $10,000 when he started managing Magellan, and you cashed out after he left, your $10,000 would have been worth $300,000. And he did it by investing in the most simple companies that he was capable of understanding. He did it investing in La Quinta Inns. He did it by investing in Dunkin' Donuts, Taco Bell, all these things. Here's him one more time.
I'm saying people have natural advantages.
Yeah.
Let's say what you do for a living is you're involved in the restaurant industry.
Right.
You supply paper products. You supply kitchen equipment. You help build restaurants.
Right.
You saw McDonald's. You saw Chi-Chi's. You saw Chili's. You saw Cracker Barrel. You saw Dunkin' Donuts, Kentucky Fried Chicken, Taco Bell.
These are all success stories.
These were 40-fold. You made 40 or 50 times your money. You don't need to make that kind of money many times in your life, right?
Yeah, no.
That's all you had to do was follow the restaurant industry.
Yeah.
People are in industries. They're in the publishing industry. They're in the chemical industry, the paper. Why don't they just stay with that industry? You only need a few stocks a decade. How many good stocks do you need in a lifetime? Instead of people, they're in the restaurant industry. They're buying biotechnology stocks. Right. The people in the chemical industry
nothing about
know nothing
biotech.
about it. The people in the chemical industry are buying oil stocks.
Right.
It's absolutely absurd. People don't understand their natural advantages, and they don't use them. So that's bad, number one. But worse, number two, is if you don't think you're a good ice skater, or if you're convinced you're not a good cellist, you're not going out and try it. But people are buying stocks anyway. Yeah. They're not discouraged. They just think it's a gamble. Yeah. So therefore, they go forward and they bet on one stock for a week and a half, and it goes up, and they make $2 on it. Then they sell it, and they buy something else. When 3 years is over, all they've done is generate a lot of commissions, and they've probably lost money. That's a mistake.
So your advice is what?
If you don't understand a company, if you can't explain it to a 10-year-old in 2 minutes or less,
yes,
don't own it. Because when it goes down, let's say the stock goes down 2 points.
You won't understand what's going on.
What do you do? Do you buy more? Do you flip a coin?
And chances are your broker doesn't either?
He or she certainly doesn't know about it. I mean, who knows what all these things are with auto-backed planes and mega flops? Who knows what all these
So buy what you know.
Buy in your industry, buy what you know, buy local companies.
So what should you take away from this? Is there any way to get Nvidia into your circle of competence? I actually think it is possible. And Warren Buffett disagrees here. He thinks that you can slightly move your circle of competence. But if you look at all the ways Buffett has made money for Berkshire Hathaway, insurance, banking, stamps, back in the early days, I'm referring to the early days, these weren't immediately in his circle of competence, but he studied businesses like an insane person. At his peak, he said he would read 500 pages of annual reports in a single day. Now, we don't need to be Warren Buffett, but even if we want to be able to replicate a quarter of his success, we should be studying the crap out of him. Just a reminder on how good Buffett is, Berkshire Hathaway stock could drop by 99.9%, and it still would have outperformed the S&P 500 since 1965. So we don't need to be as good as Buffett, but if you want to be a great basketball player, you would absolutely be studying the habits and techniques of, I don't know, Kobe Bryant. I'm not a huge basketball guy, so if Nvidia is in your circle of competence and you think it's undervalued after this 5% drop, go ahead. You should absolutely be buying. But if you're not sure what a GPU is, or if you're not sure what CUDA architecture is, or if you're not sure what a data center is, and those are really topical things, you can go way deeper on Nvidia, then you have two options. You can either just dollar cost average in the S&P 500, in which you will have exposure to Nvidia because it's so large, or you can study your ass off and learn everything you can about the business. There's nothing wrong with either options. There really isn't. Because even if you study the crap out of Nvidia and you learn all about semiconductors and you learn all about the business, that's something you can carry forward in your own business career, and it's something that you will not regret. I made a video on how I made over $1 million in 2024. And I showed the receipts on how I did it. And it mostly came from my day job. The young startup we're working on, Flank Investing, is nowhere near ready to be self-sustaining. So I work a day job so I can keep this thing funded, so that we can make the dream of bringing intelligent investing into the mainstream a reality. So the $1 million I made in 2024 wasn't due to me investing, but I believe to my core that I'm better in my day job because I'm an investor. I'm selling to businesses, and I understand what businesses' pains are. I understand how they work. I can see the chessboard better because I'm an investor. As Buffett once wrote, I'm a better investor because I'm a businessman. I'm a better businessman because I'm an investor. I love that quote, and it drives me. Now, that was a lot of theory, and I just can't make a video that doesn't have a little bit of analysis in it. So let's talk about why investing in Nvidia is so hard right now. And that's because to be a Buffett-style investor, you need to buy a great company trading at a fair price. And that last part is kind of the tricky part. There's no doubt that Nvidia is a great company. Their rate of innovation is astounding. But if we look at the data for the business, we can see that they currently have a PE ratio of 58. What that means is if you bought the entire company at the current price, $3.66 trillion, you have to be pretty rich to do that, I know. It would take you 58 years off of their current earnings to make up for that investment. That's a long time. So is it wrong to buy stocks that are trading at high PE ratios? No, I don't think it is. I actually bought Tesla back in 2016, and it had a crazy high PE ratio back then. And it's okay to do that, but you need to understand that the market is mostly efficient. Analysts on Wall Street are trying to figure out what those future cash flows are. The way that you justify a high PE ratio is if the earnings are growing so fast that they can bring down that PE ratio. And Nvidia has been growing that denominator, the earnings part, pretty astoundingly. Last year, it grew at 581%. The real question is, can it continue to beat at that rate? Remember, nothing grows forever. And Buffett talks about something called the law of big numbers, meaning that it's really hard to compound when you become a massive company. Nvidia is the top 5 largest companies in the world. The law of big numbers definitely applies. So the true question of it is, will they be able to grow at that insanely high rate moving into the future? And I have no idea. And I've studied this company. I've read their annual reports. I've been following Jensen for years. I understand the technology at a base level. I play video games in my spare time, which was their original core market. Obviously, I wish I would have bought back then when it was a little bit easier to understand. But, the way in which you value a productive asset is to lay out the future cash flows and then discount them back to present day. And trying to do that academically can be a huge misstep. I know because I walked it. About 5 years ago, I read 2 whole textbooks on trying to figure out valuation. And I found myself getting frustrated when I did it. I wanted to figure out how to get a fair valuation on a company with no doubt in my mind. So then I went back to my roots, Buffett-style investing. And when you look at how Buffett values companies, he will say that he does discount. He would say that you lay out the future cash flows of the business from now till judgment day and then discount it back to present value. But of course, his philosophy comes down to a little metaphor.
Aesop said a bird in the hand is worth 2 in the bush.
Which, it's like, okay, how do you make a valuation off of that? Well, here's Buffett to answer it.
Now, he said that around 600 BC or something like that. But that hasn't been improved on very much by the business professors now. Now, the question is, how sure are you that there are 2 in the bush? How far away is the bush? All kinds of things. What are interest rates? But, Aesop wanted to leave us something to play with over the next couple thousand years, so he didn't spell the whole thing out. But that's what intrinsic value essentially is. We don't. Graham would say that. Phil Fisher would say that. Phil Fisher would say that in calculating that, he would want to look a lot harder at the qualitative factors of the business in making that estimate of how many birds were in the bush. Graham would say he would want to see the bush, $2 worth of cash in the bush, and to pay $1 for it now. And one emphasized quantitative factors and one emphasized qualitative factors, but neither one would have disagreed with the math. And I started out very influenced by Graham, so I emphasized quantitative factors. Charlie came along and said I was all wrong, and that he'd learned more in law than I'd learned in financial studies and everything, and that I should think more about qualitative factors, and he was right. And Phil Fisher said the same thing. But that's what intrinsic value is about. If you buy a McDonald's franchise, if you buy General Motors, whatever it may be, the real question is, A, are you going to have to put more cash into it after you buy it? But it's really cash in, cash out, when, what discount rate, all the standard stuff.
So in order to understand how far is the bush, how many birds are in the bush, for Nvidia, you have to understand the company. You have to bring it into your circle of competence. I believe it's possible, especially if you work in technology or a gamer or have studied the company before. But what I'll challenge you to do is study the crap out of it. You think you know enough, double the amount that you study. And I think that if you do that, you'll know better than I whether or not you should be buying Nvidia. Thanks so much for watching that video. We made a full course outlining how to pick a stock like Warren Buffett, and we have a whole section on valuation. So if any of that didn't make sense, it sure as heck didn't make sense to me for the longest time, you can check out flankinvesting.com. There'll be a link to it in the description. There will also be a link to our free Discord in the description below. If you really like nerding out about stock analysis, company news, company analysis, then come check out what we're all about. We'll see you in the next one.